Hello and welcome. I'm Cassandra Baldini with Financial Standard. Naturally, the dominant driver of investment decisions is returns. However, it's been anything but easy to navigate the landscape over the last few years, and looking ahead, the future appears equally as complex. Joining me today to share some insights on opportunities outside traditional asset allocations is MaxCap Group Executive Chair Wayne Lasky. Wayne, thank you so much for joining me.
Oh, absolutely. And thank you so much for having me.
So Wayne, in the rapidly evolving investment landscape, what changes are expected in investor strategies for the coming years?
I think we've already started to see some of these changes emerge. If we think about what served investors well for a long period of time, the old 60-40 model, 60 in equity, 40% into bonds. Clearly, that's struggling at the moment, and for good reason. You've got increased volatility, you've got subdued growth, and you've got a new normal emerging with interest rates, but they're higher. So in that context, there's really a search for alternatives. Private investors have been at this game for some period of time, and we've seen institutions really dive in to the alternative space too. And so within that domain, private credit is very much the plat du jour. Within that construct, commercial real estate credit is gaining a lot of attention.
Can you provide an explanation of commercial real estate debt as an asset class for those unfamiliar with it?
I think if we think about it in simple terms, when you look at all the different forms of real estate, whether it's industrial or whether it's hotel, office, residential, fundamentally it requires funding in order to execute those different real estate strategies that the owners of that real estate have. So commercial real estate credit is actually the finance to execute those strategies. So very similar to the way the banks do it, the non-banks are actually offering vastly similar alternatives in market, and that's the simplest way to think about it. It's the execution of those real estate strategies, and it's the funding that enables it.
And what are some of those benefits associated with investments in commercial real estate debt?
I think it's important to think about commercial real estate debt really as fixed income replacement. So for a very long period of time, it's been hard to get outsized returns or alpha in public markets. So really one needs to look towards the private markets typically to achieve it. And within that, commercial real estate credit offers that fixed income replacement. Now, what do I mean by fixed income? What you've got is a known rate of return, you've got a known maturity date, you've got absolute focus on capital preservation, pretty much in all circumstances. You've got really reliable high income that's generated out of the asset as well. And for the more sophisticated managers in the marketplace will often provide a vehicle that enables investors to access some liquidity in what is and what has historically been a fairly illiquid product. So, if you distill all of that down, I think it's a pretty compelling moment in time for this asset class because you've got quite a low risk profile relatively and outsized returns. And there aren't many asset classes that are offering that.
Why do opportunities exist for this asset class in Australia?
So I think we have to zoom out and go back to the GFC. Really, what happened is well understood by this stage, but you had the major banks who were really too big to fail. And so the regulator, whose primary responsibility is the structural stability of the financial sector, needed the banks to deleverage their balance sheet. So we saw this take place in the US, the epicenter, clearly. Not long after the GFC, we saw it happen in continental Europe and the UK. What was surprising is it took until 2017 for regulatory intervention and the first of the Basel III guidelines to really be felt in the Australian marketplace. So what this means is we're much earlier cycle in Australia. The banks continue to deleverage their balance sheets, and it's important they do so. the non-bank sector is moving in and really starting to become a very important partner alongside the banks in the ecosystem. If you think about it relative to other markets, and it's often instructive to compare, if you look at the US market and the UK market as just two examples, you see that over 50% of all commercial real estate lending is actually done by the non-bank market. And so in Australia, it is dramatically smaller market share. And so, it's instructive to understand why we are where we are, but one can also see how scalable and sustainable the opportunity is moving forward. And then I think it's also really important to understand why it's important, because zooming out again and thinking about the Australian macroeconomic position, really what we need to see is a seamless transmission of credit to creditworthy borrowers with creditworthy assets. And so we do understand clearly you only have to walk down the street to look at all different types of real estate at different stages of its life cycle. Those different pieces of real estate, they need different solutions at different moments in time. So to have just a one-size-fits-all model, that's never going to work from just a basic market perspective. And again, this is why it's so important to have the diversity that both the banks and the non-banks can provide.
What is the current outlook for the commercial real estate market?
Normally when, I've been on the public record talking about this, I try to encourage people to move away from, the immediacy of a market, gyrations, etc., because there is often recency bias. At MaxCap, we are much more fundamentally driven, which is to say we're focused really on what are the long-term drivers, often generational in nature, that are highly likely to generate outperformance in a sector. So in that context, we really zone in on the living sectors. So think about the residential market. That could be broadacre subdivision, it could be high density, and it could be lots of other types of residential offering. In addition, you can think about, purpose-built student accommodation, and what are the fundamentals really that are underpinning that? We know that pre-COVID, the population growth of Australia was very high. In fact, 3 times the rate of the US and the UK. We know that post-COVID, we're hitting new highs in terms of immigration, and rightfully so. What a fantastic country. I'm a little biased, but for all the reasons that people wanted to come to Australia pre-COVID, add the fact that we're a pretty large island with a world-class healthcare system, one can quickly understand that growth is likely to continue. And so what's happened to the supply? Well, clearly the supply has really fallen off the edge of a cliff. And it's been spoken about for some time now. MaxCap's been talking about this for a number of years, that, we do face the prospect of, arguably the largest undersupply of housing since the Second World War. And that's a very difficult issue, because there are many social implications with that as well, and governments are wrestling with this. But it's going to take some time for that product to come into the marketplace, and in the intervening period of time, certainly over the next 5 to 10 years, there is a great opportunity in that sector. And then, in the logistics sectors, the industrial, again, pre-COVID, what are the trends? We saw a big uptake in e-commerce, right? And now coming off a low base, but really growing quite rapidly. Clearly, COVID really kicked that trend along. And what we've seen post-COVID is quite interesting, because as the world starts to grapple with a deglobalization, what that really means is there's a greater need for, locally based or regionally based distribution centres and the like, which is clearly increasing demand for this type of product. So again, we can see long-term drivers supporting those sectors, and we can see a very positive future and also, quite a bright current market environment for those. Other sectors, they are battling some headwinds. in the main, but that's not to say there aren't some exceptional opportunities. It's not to say that there aren't some great operators and owners of those types of real estate. There are, but certainly one needs to be a little bit more circumspect and certainly selective in approaching those sectors presently.
How can investors access commercial real estate debt investment opportunities?
Clearly, we know investors have choice, and we've spent the best part of 2 decades listening to what investors really want and then trying to develop product that intersect with what their needs are and what the market opportunity presents. And so our flagship evergreen fund called the MaxCap Investment Trust really is the result of that journey. And in that fund, what we're talking about is really a highly diversified portfolio of loans, access to MaxCap's highest grade institutional quality product. We wanted to create some choice for investors, and so in doing so, we provided a defensive option, which is 100% first mortgages. Ultimate sleep at night factor there. And for investors that choose that option, they are looking at 5% over the cash rate net return. So think about that at the moment in the sort of 9+% return rate, which is really exceptional, for risk-adjusted returns. For those investors that want to go just ever so slightly higher up the risk curve, we have a high yield product sitting there. So that's another option. And in the high yield, you've predominantly got first mortgages, but with a few second mortgages. And so what that does is it offers 8% over the cash rate. Again, today's terms, think about that as 12+% returns. And so, it's great for investors to have those options. I think what we've been able to do through that product is create, some liquidity as well. And I think that is on the basis of what our investors, both domestically and offshore, have told us. That's really an important feature. As well, we have the ability to rapidly deploy capital. So as investors make their decisions, once those decisions are made, often it's very important to then get the money to work. And that's something certainly that the fund is able to achieve.
Well, Wayne, thank you so much for sharing that with us today. Some really valuable insights.
Oh, it's an absolute pleasure, and I'd be delighted to come back anytime.
And thank you for joining. See you next time.